Hi, everybody, and welcome to the podcast. Today, we're going to be talking with Chris Coulter, one of our lending experts, about the bank failures that we're seeing out there. We're going to talk about what's causing them, give you a little background of how banks function, and most importantly, how this will affect real estate into the coming summer months. Stay tuned. Okay, welcome back. So, Chris, I think we're up to, 3 or 4 banks now that have gone under? What's the count?
4.
4.
Well, 3 have gone under. The 4th is on the rope. Credit Suisse is on the ropes.
Credit Suisse is on the ropes, and that is a Swiss bank, I assume?
It's an international bank, more not as much of a presence in the United States. Certainly somebody that you've heard of, but yeah, their branch locations are not prolific in the States.
Got it. Okay. So what happened?
Yeah, so if you woke up and you were a technology company operating on the daily and you had $1 million deposited in Silicon Valley Bank, yes, what should have happened is you woke up and instead of your balance being $1 million, when you logged into your account, it was $250,000 because that's what the FDIC insured. That's not what happened. Basically, the Federal Reserve made a borrowing vehicle available to HSBC to step in and purchase Silicon Valley Bank. And beginning Monday morning, any depositor that had any amount of money deposited into Silicon Valley Bank was able to withdraw 100% of what they had in there on Friday afternoon on Monday morning. So they made all of the depositors whole.
So they covered the depositors
above $250,000.
So in other words,
they broke their own rule.
So they broke their own rule. Nobody that had an account basically had an effect. Did the investors get the same bailout? The people who owned stock?
No.
So the first piece did happen. That money was expunged from the market because now it's an FDIC insured. So if there was $100 million, for make-up example, in stocks sitting out there in the market, they went to zero.
That bank's worth nothing.
So that bank is worth nothing. The $53 billion that the Fed just either printed or borrowed or pulled off their books, however they did it. We don't know the answer to that question. That was just infused into the market for HSBC to buy this bank to make everybody else whole. How does that affect inflation?
Yeah, it's a great question. So basically, the natural consequence of the decisions that Silicon Valley Bank's investors and board made led to the loss. Yes, they thought bonds were a conservative investment. However, they did miss the fact that they were about to enter into an inflationary environment, and knowing that inflation erodes the value of a bond, they missed that risk. So the natural consequence would be all of that value is wiped out, and all of the money that those technology companies had on deposit at Silicon Valley Bank would be gone because they also took a risk in depositing their money into Silicon Valley Bank. Looked at their books, decided this was the bank that they wanted to use, and that money the value of those deposits as a result of the decisions the bank made would also be wiped out.
So
that's not
what happened. But in theory, basically, if a ton of the inflation that was created, which it's not solely this, if a ton of the inflation that was created as the result of the pandemic, all of a sudden got pulled out of it, it's almost like fixing part of the problem.
Yeah, it
right?
would. Yes, it absolutely is. All of the facts about the money on deposit at Silicon Valley Bank are that when they woke up on Friday, that money was no longer there. Truly, it was gone because of the decisions made by the board. That the money was gone. Okay, now by insuring deposits above their $250,000 limit, they basically injected that money. They just pulled the money out of nowhere.
From wherever.
They printed it.
They either printed it, borrowed it, or they pulled it off their books, but nothing says that they pulled it off their books.
And they gave it to the companies that had money on deposit in Silicon Valley Bank. That's new money.
They loaned it, though, right?
The potentially, yes, they loaned it.
They loaned it, but it's new money that didn't exist.
They injected those new funds into the economy, so that then that Silicon Valley, those depositors and those customers could pull their funds out and go operate their businesses. So that money went
doesn't
back into circulation. That
So-
much money went back into circulation.
So a horrible situation, a bank fails, yet it does actually help typically the vehicle of slowing inflation down. So it's like you have this negative thing, but you have a positive outcome. We took a negative thing and made it even more negative because correct me if I'm wrong, but if you inject 53 billion or whatever the actual number was into the economy, didn't you just create more inflation?
You just poured gas on the inflation fire. Yes,
Right.
absolutely.
So literally,
There will be a consequence to that. The consequence will come in the form of higher prices on, autos, homes, goods, and things like that. So yes, that will not help the inflation they're trying to curb.
All right. Well, so now let's talk about how this affects our clients in the
All right.
real estate sector. So we know that the Fed has been raising the interest rate. Last conversation that they had on this topic was they'd be meeting next week, probably the week that this video comes out, and that they'd be potentially raising it about a half a point. Is that correct?
That's right. That was, yes, before last week. Yes.
0.5%. I should say half a point. So that would be, is that 50 or 500 basis points?
Yeah, 500 basis points.
So 500 basis points.
I'm sorry, no, it's 50 basis
50
points.
basis points,
Yes.
a 0.5% coming up in this, which would drive interest rates up a little bit more in doing this. Now that you've seen this, if they come out and they just don't want to, they want to save face and they raise that 0.5%, we should see mortgage interest rates climb, correct?
Yes, you should.
Okay. So what do you think they're going to do? Now we're getting into speculation at this point,
Yeah.
right? So if they go, oh my gosh, all this rate hiking just caused banks to collapse. We didn't intend that. We need to do something about it. What happens if they come back and say, you know what, we're only going to raise it a quarter point? How does that affect the real estate industry?
Yeah, it does. It affects it in a positive way for the purchasers of real estate because I think that what the Federal Reserve is looking at is they're looking at their options. They're having to do two things at once. Number one, they have a mandate to fight inflation, and number two, they need to stave off a recession and a lack of confidence in the banking system. So they're at cross purposes with each other. That's the problem. But the way it's going to affect is the Federal Reserve is going to look at what just happened. They're going to realize that the failure of those banks was a direct result, at least in part, by the actions that they took and how quickly they had to raise these rates once they realized that inflation was not transitory, that it was here to stay and it was permanent and it was an entrenched problem. Okay, so then they can, so they're going to have to back off of that policy, or this is one thing they could be thinking, is that they may have to back off of that aggressive rate hike policy that they felt like the economy demanded, and the economy's still been clipping along at a good pace. Now I think they're going to have to say, okay, we're going to need to slow down these rate hikes. We don't want any more of these banks to fail. And what's going to happen then is you're going to see mortgage rates come down.
Okay, so if the Fed doesn't raise the rate at all, obviously there's multiple implications, right? Like there's good and bad ones. Let's keep it confined to real estate. What happens to the real estate market? I mean, in terms of mortgage rates. What happens to mortgage rates?
Yeah, in terms of mortgage rates, I think that you see them fall significantly. I mean, you've already seen that. We've seen that since Thursday and Friday of last week. You've seen a significant decrease in 30-year fixed rates.
Okay, so define that. What's significant?
Yeah, absolutely. So, I mean, about 0.5%.
Okay.
Where rates were pushing 7% on a 30-year fixed, and they're hovering around 6.5% right now on a 30-year fixed.
Okay.
In general.
All right. In general, so we got about 0.5% increase. So
decrease.
I'm sorry, 0.5% decrease in the 30-year fixed rate. If the Fed comes out next week and says, you know what, we're not going to move the Fed rate at all, what is your best prediction? Even though you don't know, because there's no way to know because of there's too many factors in it. But what's your guess on what happens to mortgage interest rates? Yeah, obviously they fall.
They fall.
But I mean,
the immediate reaction is that they're going to rally. They're going and that means that they're going to fall.
Got it.
I would say that if we've already seen roughly 0.5% of a decrease, I would think a 0% increase would be a sign that the Federal Reserve thinks that there's additional instability in the banking sector and the rates would rally down to another 0.5%, I would say.
Okay, so you're thinking,
however,
likely it could be 6 or better depending on how the market rallies.
That's right.
Got
That's
it.
right. But at the same time that they do that, there's so many unknowns, and this is where we get into unprecedented things that nobody really knows the answer to how they're going to play out, because what's going to be looming behind this push down in rates is we still have a problem with inflation that we haven't solved, that arguably we've made worse by injecting more money into the economy.
So the market that controls mortgage interest rate is going to be the bond market?
Yes, that's correct.
Right. So what you're basically saying is, if they don't raise the rates, the inverse issue is investors could still have less confidence that we're dealing with the inflationary issue, and therefore the bond market goes in the wrong direction and rates go up.
The Federal Reserve is stuck between a rock and a hard place.
Yeah, because how do they solve?
The rock is inflation.
Got it.
Okay, the hard place is bank failures or recession.
So
okay,
so the up or down of the interest rate is like, if they raise interest rates, they combat inflation and topple banks. If they leave it or lower it, which God forbid, I don't think they're going to lower it, but if they lower it, then
they fan inflation.
You fan inflation, but you create some stability in the banks.
That's right.
Okay.
Pick your poison.
Pick your poison.
And we don't know what, if inflation was to continue at this rate, then, that is basically.
And we're currently at 6%, correct?
Yeah, currently clipping at 6%.
Okay.
Means it's obviously the price of things is going to continue to, it's probably not going to stay pat, it's probably going to begin to go in the other direction if they take away the policy they're using to combat inflation, while at the same time injecting a lot of cash into the economy.
Okay.
That's going to create, the cost of all goods are going to go up. The value of the dollars you currently hold are going to be less because there's more money in circulation just naturally.
Wow. So this is basically a lose-lose situation. So
unfortunately.
Yeah, so they've created a lose-lose situation
for themselves.
We
don't know how it's going to play out.
And so it's anybody's guess how they respond, because either way, they're either going to shoot themselves in the right foot or they're going to shoot themselves in the left foot. And so what we don't know is we're all taking overs and unders on which foot they're going to shoot.
Right, that's exactly right.
Okay. All right. Well, so
and then what happens to the foot they don't shoot?
Yeah, what happens to the foot they don't shoot? But what we can say with potentially some level of optimistic outlook is if rates flatten, they either don't raise the Fed funds rate, or they only raise it about half as much as what they said they were going to do on this. We see interest rates improving, which is going to actually make a window for the buying community and the selling community to capitalize on values of homes, which will create some stability for our sector moving forward, at least in the temporary.
It feels to me like this is good for housing.
Okay.
From the standpoint of exactly that, of just cheaper borrowing costs for people purchasing homes, and maybe that convinces some sellers, to actually get off the sidelines and list their homes and get into the market. I think that maybe would loosen up the inventory problem a little bit.
Wow.
So I think there's a lot of really positive things that could happen to housing. I think there is overall some danger lurking, in the economy, and it's just we're going to see how the Federal Reserve is able to navigate that in a way that walks a very thin line between not allowing the economy to go into a recession, and keeping the price of goods at least affordable.
Right. Yeah. It's such a wow. This is quite a conundrum.
It is.
So the last question is: so we basically answered this. Number one, we are not telling people to go do a run on banks, because we don't see SVB the same as all the local regional banks that are invested in a different way. Number one. Number two, the FDIC is insuring you up to $250,000, and if you have less than that, and they're assuming the federal government and our nation stands, you're basically covered as far as that goes at a rudimentary level. And number three is nobody can truly predict what is going to happen, because this is unprecedented. Have you seen anything in the prior crises that we've had in the financial world from the Great Depression on forward? Has anything quite had this makeup?
No. I mean, I have not seen the rock and the hard place scenario where there wasn't really a good way out. They're trapped a little bit. So no, I wouldn't have anticipated that this was the position that they would be in, and I've not seen it happen before. I'm not withdrawing my money out of the bank.
Yeah, no.
We haven't stopped lending money. I don't think that banks and financial institutions are going to not be in a position to lend. I think that we've got a really strong job sector in the economy. The labor market is really, really good, and I think as long as people are earning, then our economy is going to end up. We're going to be able to navigate these.
Got it.
In a positive way. I just don't know what the end result. I think probably they're going to, of course, have to shore up the banking sector, and then I think they're going to delay their solving of the inflationary problem. I think they're going to push that down the road.
I honestly am making the same prediction. I'm honestly predicting that at least as far as local Georgia real estate economy is gonna go, is that we're going to see an easing of the rates coming back into affordability, which is going to make a hot, fast, heavy summer of fast-paced moving pieces of real estate, and you're going to be up against competition again.
But then we're going to have to come back in the fall and go, okay.
Now, how do we quell the rest of this?
Let's go back to work on this inflation issue.
Right. Because they can't ignore it. It has to be dealt with.
Yep.
But the question is save the banks and then deal with inflation, or let the banks collapse and that deals with inflation. It is. I mean, I'm simplifying it at a pretty high level of simplification, but that's kind of the what the Fed has to wake up and look at. They're like, save the banks, save the inflation. Like, those are the two things that they're looking at. Like, what do I do first? And realistically, they have to go, what is more important to stabilize now, and then come back to stabilize the other one later to cause the minimum amount of damage would be the intelligent question to ask.
Yes. Right,
and I don't know the answer.
But also, I don't either. And but I will tell you this: you could consider inflation a tax. I mean, if you really look at, okay, this is not a taxpayer-funded bailout of these financial institutions. Well, I mean, yeah, there was no direct use of taxpayer funds to shore up these financial institutions, but the result of the money that they inject into the economy is going to be higher prices of goods, and your dollars are going to be worth less than they were yesterday. That's a tax on the people. So they just redistributed the bank's problem from just the bank having to face the consequence of what choices they made to distributing that over the population.
Everybody who has a dollar and now shared in a portion of that bailout.
That's right.
Because it affects it. This is going to be the remains to be seen. So we're going to stay on top of this topic. We'll probably put out some more content on it. This is going to be a great hallmark in time to be able to say what we were looking at when we looked at it. And then we'll come back and do a video once we've seen how they're choosing to behave that could kind of run in the series of cause and effect. Right? This is what the banks are doing. This is how it's affecting us, and see that play out. Because I really think that looking back and having a good context is the only way that we don't repeat history.
Agree.
All right. So stay tuned. We'll talk to you soon.
Have a great day, everybody.